Hi, it's Musharraf Hussain with the subject of interpreting taxing statutes. Our today's topic is taxing statutes. Composition of taxing statutes. Taxing statute is composed of Act of Legislature, for example, Income Tax Act 1961, Central Goods and Service Tax Act 2017, Custom Act 1962, Finance Act, etc. And delegated legislations in the collective form of rules, for example, Income Tax Rules 1962, Central Goods and Service Tax Rules 2017, etc. And in the standalone form of notification, exemplification notification number 1 oblique 2017 hyphen central tax dated 19 June 2017 enforcing provisions of CGST Act 2017. The status of delegated legislation. Delegated legislations are notified in the official gazette and laid before the parliament or a state legislature. And so they are read with the concerned taxing acts as a part of that act but are subordinate in authority. So any delegated legislation in contravention to the provisions of the taxing act is held as ultra vires and void. Circulars are internal instructions and issued by the department to its field formations. They are circulated but neither notified nor laid before the parliament or a state legislature and so do not have much force of law for the assessee who is free to follow it. The tax department, however, are bound by such circular as a matter of instructions from their superiors. Judicial precedent. Unlike the civil laws where the rule of law is recognized by the courts too, the role of judiciary with respect to taxing the statutes are limited. The role of judiciary is limited to validating the taxing act against the Constitution of India or validating the delegated legislations against the concerned taxing acts and to clarify the ambiguities in the provisions of the taxing act and the delegated legislations thereunder. The judicial discipline, however, is maintained and the lower courts cannot alter the meaning ascertained by a higher court. Self-contained court. Taxing statutes are self-contained courts for raising of revenue and matters related therewith. It contains provisions for charge, payment, return, assessment, and adjudication. Charge implies the quantum of tax payable, the event on which the liability arises, and the person liable. Payment implies payment of tax to the exchequer, including the recovery and refund by the exchequer. Exchequer here means a state or the either central government or the state government. Return implies provision of information by the taxpayer to the exchequer regarding the tax liability and its disposal. Assessment implies determination by the exchequer of the correctness of the tax liability and its disposal. And adjudication implies resolution of disputes arising between the taxpayer and the exchequer in respect of charge, payment, return, or assessment. Charging and machinery provisions. Provisions levying the tax or fixing the liability of tax is called as charging provisions. And provisions in respect of payment, return, assessment, and adjudication which effectuate or bring into effect the charging provisions are called as machinery provisions. Charging provision. A taxing statute cannot stand in absence of charging provision, for it stipulates 1. The person liable, 2. The tax base, 3. The taxable event, 4. The taxable amount, and 5. The tax rate. Person liable. The first and foremost thing which is prescribed is the person who is liable for the tax. The person may be natural or artificial. After identifying the person liable to tax, it is significant to specify the subject matter of tax, that is, on what amount the person is liable to tax. It may be the income earned by the person or the value of goods and services provided by the person or the value of consumption made by the person or the value of property held by the person, etc. Taxable event. After specifying the tax base, the next important specification is the point which will trigger the tax liability. For example, the income earned or goods sold. Taxable amount. The next comes the determination of taxable amount on which to levy the tax. For example, the total amount of income earned during a year or the total value of gold sold during a month. Tax rate. Once the taxable amount is determined, the next remaining thing is to apply the tax rate to decide the quantum of tax payable by the person. Issue often arises in application of tax rates when there is a change in rate. In case of income tax, it has been statutorily fixed that the tax rate on the first day of the assessment year will be applicable for the taxable income earned during the previous year. In GST, it is fixed as the date on which the advance is received or the goods are provided or the amount is billed, whichever is earlier. Summary of elements of charges in taxing statutes. It has been summarized in a tabular form. All the 5 elements, the person liable, tax base, taxable event, taxable amount and the tax rate is shown in the first column, and the corresponding provisions of Income Tax and Goods and Service Tax Act is shown in the second and third column. We can see that person liable in both the cases are individual or it may be a company or firm, etc. The tax base in case of income tax is income earned, whereas in GST it is value of goods sold or services provided. The taxable event for the purpose of income tax is earning of income, whereas for the purpose of GST it may be sale of goods or services. Taxable amount for the purpose of income tax may be the total income earned during a year or more specifically previous year. In Goods and Service Tax Act, total value of goods sold during a month can be the taxable amount. Tax rate as a sample has been taken. For income tax it may be 10% and for GST it may be the 5% or whatever. So I think in this table we have illustrated the different charging components with respect to income tax and GST Act. Thank you.